Some of you may recognize this quote from the introduction of the 2015 film, The Big Short. At the time, it was an admonition about beliefs surrounding the collateralized mortgage bonds that created the great financial crisis. Today, however, these words are a warning about the fundamental things you think you know for sure about investing. Diversify and stay invested. As Warren Buffett once famously said, diversification makes very little sense for anyone who knows what they are doing. It is protection against ignorance. But the cornerstone of portfolio management is diversification, which in turn relies upon negative asset price change correlation. So, if you believe in diversification, you necessarily believe that negative price change correlation will adequately protect you against losses, because long-term market timing is impossible to achieve with enough consistency to make it a viable alternative to diversification. The most important correlation is that between stocks and bonds, and as you can see, it varies greatly over time and loses a lot of its risk mitigation value during times of market stress, like the one we are in today. Traditional portfolio management observes the historical risk and return of major asset classes, like stocks and bonds, in order to assign an allocation for your portfolio in accordance with your return goals and risk appetite. However, the risk and return profile of different asset allocations changes wildly over time, making it nearly impossible to drive this investment vehicle while looking out the rear window. And just in case you thought more diversification was the answer to this problem, you would be wrong. Some of the presumably savviest investors have experienced 30 to 40% drawdowns and long recovery periods, even with extensive portfolio diversification. But they can probably better afford to be in drawdown and recovery for deeper and longer than you may be willing to bear. Besides, this entire approach is based on the assumption that market timing is not a viable alternative investment approach. The performance of the Renaissance Technologies Medallion Fund provides the ultimate counterexample to the efficient markets hypothesis. It has avoided negative returns in all but 1 year and provided extraordinary returns, even net of a hefty 40% management fee. It did this through the bursting of the dot-com bubble, the great financial crisis, and whatever you want to call the 2022 sell-off. Note that the chart above is on a log scale. Wealth managers will explain the Renaissance example as being a unicorn, which is closed to new investors. While this is true, they may fail to avail clients to other tactical approaches with absolute return investment goals, which also have a long-term track record of enhanced returns and low drawdown, which remain open for new investors. Steady positive annual returns during the last 2 major market corrections have been a remarkable achievement of the Medallion Fund, and it is not the only investment alternative that has done so. During the 5-year period surrounding the great financial crisis, average return for equity, bond, and asset allocation investors was low or even negative, but a viable tactical approach, which had investors entirely out of the market when warranted, produced strong average annual returns. And the same was true during the 5-year period surrounding the bursting of the dot-com bubble. What are the things you think you know for sure? That diversification and the Federal Reserve will save you. That tactical approaches are not viable substitutes for diversified portfolio management. That the recovery from the next big drawdown will be swift. Be careful, because it may be the things you know for sure that get you. During times of volatility and uncertainty, try to question what you think you know for sure. To learn more about a successful tactical investment approach with a long track record of enhanced returns and low drawdown, contact Mike at Trendhaven Investment Management.